Welcome to Wealth Coffee Chats, folks, for your daily live updates. Get the most out of today's episode by participating in the chat. Make sure you ask some questions, be part of the conversation, have a bit of fun, grab a coffee or a tea, take some notes, and get ready to start your day, folks. Quick few housekeeping rules, though. No spamming, no advertising or self-promotion in the chat. That's not on. Be kind and respectful to everyone when participating. And most of all, have a good time. Real estate investing can be your biggest asset. It also can be your most expensive asset when it comes to getting it right or getting it wrong, folks. It can be time-consuming, stressful, and that's why here at Positive, we have what's called a 6-star team, a full-service team that provides integrated wealth and property investing solutions and services simply designed to help you progress towards your goal of passive income through your property portfolio, folks. Make sure you check out our other podcasts on the Positive Mentor Network. Not only is there Wealth Coffee Chats, there's the Urban Property Investor. Drops every Wednesday with straight talking investing strategies and lessons with Sam Saggers. Property Investor Tales. This is where our clients, you guys, share real life stories from property investing, hosted by some of our advisors and strategists. And that's done every fortnight, dropping every Monday. Wealth, Wine and Wisdom, folks, that debriefs the week that was in the world of finance and property, hosted by yours truly, Jason Witten and Andy Fenton on Fridays. Hey, good morning, folks.
Good morning, everybody. Welcome to another Wealth Coffee Chat.
Hope you're well, folks, wherever you are.
There it is, team. Morning. Morning, wherever you're tuning in from today.
Early bird gets the worm, they say. Here at Positive, we offer a 6-star team. It's a team that help you at every stage of your wealth creation journey.
General advice disclaimer. The information provided and made available through this podcast does not constitute financial advice. The information is of a general nature only and does not take into account your individual objectives, financial situation, or needs. It should not be used, relied upon, or treated as a substitute for specific professional advice. We recommend that you obtain your own independent professional advice before making any decision in relation to your particular requirements or circumstances. Positive Tax Solutions and its representatives do not warrant the accuracy, completeness, or currency of the information provided on and made available through this podcast.
Well, good morning, everyone, to Wealth Coffee Chats. It is Tax Tuesday, Tax and Accounting Tuesday. My name's Anthony Wolfenden. Thanks very much for putting up with a disclaimer. I've got to laugh every time I see that. We've checked the information pretty well, so we've got some good stuff for you. Today, the conversation will be on the tax and accounting subjects, of course. We have a bit of a chat about capital gains tax and, more importantly, how to reduce it. There is actually a ton of content on here. It's probably going to go over 15 minutes. So what we'll do is we'll probably split it into what is capital gain tax this Tuesday, a bit of a description of the background, how it works, etc. And then next Tuesday, we'll get into a conversation about how to manage it. Capital gains tax is a tax. It can't be avoided. It can't be evaded, if you're familiar with those terms from the ATO. Good morning, everyone. Chris, Bunty, Luke, etc. Kevin, thanks for turning up, guys. But it can be managed, and that's the key thing that I want you to walk away with. I'll get into it in a minute, but it is a tax that's taking money out of your pocket. And so just as you would never purchase a property without investigating its parameters, the legalities, all of the other things to make sure that it's a good investment, you should never sell an asset without having a plan to manage the consequences. And one of the consequences could be a tax bill. So what is capital gains tax? We call it a capital gains tax, but be very careful about it. It's not really separate from income tax. Capital gains tax is the way the government said, hey, look, there's people out there that earn an income and we charge them income tax when they make income each year. But what about people who invest in property or real estate or any other sort of asset class? When they buy it and sell it and make a profit, you know, that's money in their pocket. Maybe they should pay some tax on that. And there used to be a way of doing some complex calculations. At the moment, it's really relatively simple. If you own an asset and you own it for less than a year and you buy it and sell it, the government just considers the gain you make on that, just like income you would earn. And so they tax 100% of it. It's added to your income at the end of the year, and you pay your marginal tax on it. If you own an asset for over 12 months, they used to take into account inflation, a lot of other factors. Now they're just like, okay, well, we don't really want to get too complex about this. So if you've owned an asset, you made a ton of money on it, which you can do with real estate if you do it well. What we'll do if you own the property personally is we'll give you a bit of a discount. We'll say 50% of whatever you made on that property or other asset will be added to your income this year, and it's taxed at marginal rates. So it's a tax on the gain you made for selling an asset. It is completely an income tax, and just like income taxes, it can be managed. Okay. So how's it calculated? Well, you determine the gain on the property. How much did you make? And so that's kind of the cost base. What did you buy the asset for? What's the price? What's the added legal expenses? If there's any stamp duty that gets added, did you do any renovations? These are all sorts of things that are part of what it cost you to acquire the asset. When you sell, you have a contract price. They take off any commissions and all the rest of it. And the difference between those sort of two big numbers, with a couple of other factors taken into account, is your total gain. In real estate, that can be hundreds of thousands of dollars. Having that added to your income in any given year is very likely to push you into the top tax bracket for at least some of the gain. And so the government can end up taking 47%, 45% tax plus 2% Medicare levy of the money you've made with a 50% discount. And that leads to some interesting calculations. And so this is something I want everyone on the line to remember, which is, look, if we're going to pay capital gains tax, I really fear it. I'm worried about it. I'm not sure I want to sell because there's capital gains tax coming. It is a consequence, and you do need to manage it. But that's all part of the sort of planning process. And so if you own a property or any other asset and you sell it, the most you can ever pay if you've owned that asset for more than 12 months would be 50% of whatever the gain is, multiplied by the maximum tax rate that you can pay in Australia personally, which is the 47%, which is basically 23.5% if you multiply those two numbers together. So if you make an absolute bunch of money on property, the ATO might want up to 23.5% of whatever the gain is. So it is a consequence of success. You have to sell something successfully and make money to pay that tax. And in the end, it's less than a quarter of what you've made. And so it shouldn't be something that is ducked. You should always make your decisions based on holding the right sort of assets. When you sell, all of that sort of thing should come first. And then you take the taxes into account as a consequence. So there's all sorts of special points to remember on capital gains taxes. They're typically relating to investment property. If you have your principal place of residence, it's capital gains tax free. There's only a few things that are completely tax free in Australia. One of them is your home. Another is your super after age 60. So having property there and selling it can be quite good because you don't pay any tax at all. Small business, a few other things. But yeah, if you own investment property, you will get stung a little bit on that. You can hold investments. G'day, Bradley. Welcome, Anne-Marie. You can hold investments in other entities. And so the taxes there will also come through. If you hold property, for instance, in a trust, the income is passed through, the gains are passed through. And so whoever gets the benefit would pay the tax at whatever their marginal rates are. That's where trust can be quite effective. If you hold assets like property in a company, as an example, there are investment companies, property development companies, and so forth. There is no general discount. There's no 50% discount if you hold something in a company. But then again, the maximum tax rates are also capped. So if you have a small active company, a base rate entity, they call it, go Google that one. 25% would be the capital gains tax rate, so marginally higher than what you'd pay personally if you hold longer than a year, and that's whether you hold it for a year or less in a company, because the taxes don't change. There's no discount, as I said, after 12 months. Larger investment companies or passive companies that draw all of their income from investment would pay 30% tax. So you've got to take that into account at buying time, I guess. You want to keep really good records. So in the end, if you've bought something, it's buy well, never sell, or buy well and sell strategically, as Jace would say, you want to have really good records of all of the investments you've made in the property, the original settlement documents showing the stamp duty, etc. Certainly any records of renovations or expenses you put into the place to hold it in terms of improvement, because that's part of the cost base. You want really good records of this to try and, again, reduce the total gain that's shown in the end and calculated. If anyone comes asking, having those records around will be really important. So key points: your home is exempt. You can actually move out of your home and live somewhere else for up to 6 years and still sell your property capital gains tax free. If you're holding longer than that, remember to move back in and make it your home again. You can extend that a few times. So that's one way people maintain their residency. I mean, every Australian should have at least one of their properties tagged as a principal place of residence. If you are a property investor and you don't own your own home, maybe you move into one of them as soon as you buy it, so that you've got an exemption on at least one property. It does trigger some differences in terms of depreciation you can claim along the way, but that's a consideration. Talk to your professionals about that. And I guess the key thing that we want to leave people with in terms of the capital gains tax concept, before we talk about how to minimize it next week, is the event that triggers it. Capital gains tax is triggered. The capital gains tax event is when you sign the contract or when the contract for sale goes unconditional. That's really important to note, because if you're selling a property and you happen to do it near the end of a fiscal year, say you sign the contract in May or June, and the property doesn't settle till July or August, the gain event is in the fiscal year prior to when you might receive the money. And what's important about that is you want to receive the money so you can potentially do something about the tax while you have time. So because capital gains tax is an income tax, because it's added to your taxable income in the year that the contract is signed, basically, you want to have time to reduce your taxable income in that year by having appropriate tax deductible expenses, which means you need some time to organize things. So be very careful selling late in the year and not leaving yourself enough time basically to adjust. You want to sell. If you're going to market, speak to your accountant or your financial advisor before the property is listed. Do some, or as the property is being listed at least, find out what the potential gain is and ask them how you can minimize that gain. As I said, we'll get into some of the techniques you can use for minimization next week. And if you've got any questions about the content so far, please ask, but we'll talk about minimizing capital gains tax next week. If you do talk to your accountant about it and make appropriate plans, you can save tens of thousands of dollars of capital gains tax, which is really, really very good. So I've got, I'll run through the examples next week probably, because that would be better. But I will say that I had a client for financial advice 2 years ago. They came and saw me before they sold their property. We organized the time for sale. Obviously, you sell when the market is high. And we managed to save the couple $30,000 each in capital gains tax, which was quite good. They still paid a significant amount, but that was a few loan payments, I guess, that they managed to keep in their pocket. So that's the intro to capital gains tax. We're coming up on sort of 10 or so minutes. The rest of the content's really about minimizing. As I said, I might save that to next week, because cracking into that can be a long topic. Are there any questions about what capital gains tax is before we let you guys get on with your day? Any questions at all? Put them in the chat. Let me check my notes and make sure I haven't missed anything else. Nope. No questions? Okay, guys, what we'll do is we've talked about what capital gains tax is. It's an income tax this week. It's calculated or triggered when you sign a contract to sell a property, which you don't do near the end of the year. Because property sales in Australia often result in hundreds of thousands of dollars of gain if you've held the property for any period of time, the tax consequences of that can be fairly severe. We'll talk about how to minimize that next week, and I'll let you guys get on with your day today. Thanks very much for coming to my first version and being kind with me of the Wealth Coffee Chat Tax Tuesday.
Thanks for watching another episode of Wealth Coffee Chat, folks. Make sure you like, subscribe, and turn on notifications so you never miss a thing when we go live. Folio and investing game, folks, with Wealth Coffee Chats live every morning at 8:10 each weekday. Make sure you join us. Previous episodes are also available wherever you get your podcasts, folks, as well as our other podcasts from the 6-Star team here at positivementor.com.au.